So we're always talking about Telstra every day here. Looking to get your take on the company right now.
Sure. This is, and I've said this before, and I know everyone who follows my blog and anyone who speaks to me, I'll tell them the value of Telstra has been. Look, 10 years ago, the intrinsic value of Telstra was about $3.86. That was in the year 2000. And now its intrinsic value is about $3.01. So it hasn't increased in value at all in the last 10 years. Its profits this year are the same as they were 10 years ago, and that's with all the growth in mobile phone communications, all the growth in the internet, all the growth in subscription-based television, and which they've got an interest in. They haven't been able to increase their profits. This is a capital-intensive business. It's a really difficult business. I can't see how, with all the uncertainty that exists in the next 10 years compared to the last 10 years, we don't even know what Telstra is going to look like. Very, very difficult to value, and its value today is $3. So it's trading there finally. I looked like a goose when it was trading at $9 and saying it was worth, it was worth $3.86. And it was trading at 3 times its intrinsic value. But all value investors like me, I guess, have our, have the seed of our philosophy with a guy named Benjamin Graham, who's the father of security analysis, I guess, the intellectual father of security analysis. He had this great quote back in the 1940s. He said, "In the long run, the stock market's a popularity contest, and in the short run, it's a weighing machine." So in the long run, price tends to follow value. So if you've got your price at $9 and the value's 3, then whether it takes 1 year, 5 years, or in this case 10 years, if the value doesn't rise, eventually the price will go down to the value. And that's all we're seeing now. Price and value are about the same. Everyone's been saying since about $3.60, it's a great dividend yield play and it's got a great dividend, you should buy it, and they've lost 50 cents. So you should be buying good businesses when they're cheap, not mediocre businesses when they're at fair value.
And there was a bit of a LNG story again today with Woodside CEO Don Volte dismissing speculation. The company is looking at a potential $15 billion takeover of Santos. I found it interesting that when we took a look before at those stocks that did well and didn't do well in the oil and gas space, they all did poorly, with the exception of Woodside and Santos. They finished positively. But when you run the numbers, what's your take on these two?
Well, both of these businesses are classic commodity businesses. Their returns on equity, which is, I think, a key driver of intrinsic values, have varied from, in the case of Santos over the last decade, from 25% down to about 5% today. That's a return on equity that is less than what you can get in a bank account. Now, if I came to you and I said, "Richard, I've got a business proposition for you. We're going to sink billions of dollars into this thing. We're going to try and get some stuff out of the ground, and here's my information memorandum." And you're going to say, "What kind of return on my equity will I get?" And I'll say, "Mate, we'll put the money in the business. We're going to get 5%. You'd say, "Well, Roger, that's crazy. I can get better in a term deposit. I can get 8% over 5 years in a term deposit. I'm not going to give you the money." But people regularly buy these kinds of companies on the hope that their share prices go up. And that's the other thing I want to say. When you look at those lists of losers and winners for the day, the Reject Shop is one of the top return on equity businesses in this country, Platinum even more so, and yet they were down today. Most people take their cues from share prices, and if they see the share price down, they think it's a bad company or something bad has happened, and often that's not the case at all. Now, going back to Woodside, Woodside has more debt, but as a result of that debt, higher return on equity. But again, return on equity has declined from about 40% 10 years ago to about, it looks like about 15% today, and that's the forecast. I think the value of this business, by the way, is $35 next year and $42 in 2012, and it's already trading at $47. And Santos, which is trading at about $14.82, its value is closer to $5 to $7.
Right.
So if I was going to invest in either of them, and I probably wouldn't because they're both B-class stocks, not A-class, I'd probably go for Woodside over Santos.
Okay, keen to get your opinion on Transurban.
This is one of those businesses. Do you remember Sydney Roads Group? It was a spin-off from Macquarie Infrastructure Group. It was all the older roads that are the closest to being handed back to the government debt-free. Right. Now, what Macquarie did is when they spun off those older roads, people need to remember that those roads have to be handed back debt-free. All the debt that was associated with them was put into that vehicle, that Sydney Roads Group. And so I couldn't see, and I made this comment on another network, that I couldn't see how long-term you've got anything other than a bag of debt. Now, Transurban came along and bought those roads with all of the debt. They bought the entire vehicle. They still have to be handed back to the government at some point debt-free, and you can't keep increasing distributions to unit holders if you've got increasing amounts of debt that needs to be paid off. Transurban owns that. I made the comment the other day, people think that when the Singaporean Wealth Fund buys ABC Learning Centres that they're smarter than us. People think when a Canadian pension fund comes and buys Transurban, they must know something we don't know and they're a suitable fit, for that particular asset. People pay over the odds for assets all around the world, not just in Australia, and this is no exception. Transurban comes up with a valuation of less than $1 for me, and I'm frightened to actually give you the real number because people think it'll be like Telstra when it was at $9 and I was saying it was worth $3 all over again. But its value is substantially less than the current price and less than $1.
Any media stocks on your radar?
Yeah, I have to say, Richard, this is a sector that the prices of these stocks bear no resemblance to their values. The returns on equity that you see in these businesses, apart with the exception of West Australian News, which is very, very high, but all of it gets paid out, so it's a little bit like a bond in that sense. But if you have a look at the return on equity for 10 Network, for example, we're talking 10%, not significant, 5% for Fairfax. So they're very low rates of return on equity. Prices significantly above values there, and I rate companies from A1 down to C5. Transurban's a C5. Right. These guys are C's and B's. It's just not for me. It's just not investment grade.
Okay, we've got just enough time to take a look at outperform. Is when we ask the brokers which stocks or sectors they are buying to outperform the market and outperform their clients. And why I want to do this, and we've got about just under 2 minutes to do it. Sure. We get all these emails. Oh, Roger says everything's expensive. Roger says, there doesn't seem to be any value in the market. I
think everybody watching the program needs to understand that the market, you give your money to a stockbroker and all of a sudden coincidentally on the day that you hand your money to the stockbroker, there's all these opportunities in the market. Yep. On the very day, what a coincidence. Who says there has to be enough opportunities to fully employ all your money on the very day you decide, now I'm going into the stock market? Okay, but it doesn't...
We've only got a minute.
Yeah, no problem.
Viewers at home will want to know what you're thinking's got value.
There is a company that I'm happy for people to go out and have a look at. It's a small company. It's rated an A1. It's one of my A1 stocks. It was recommended to me by somebody else a long time ago, and I had a look at it and I liked it. The company is Forge Group. I can hear everyone with their pens just writing it down now. Forge Group. You can see it's already done extraordinarily well. Its value is significantly higher, though, than even current prices. I've got a value of this company of about $4.50 for 2011 and almost $6 for 2012. Very hard. You can't get forecasts on it. I don't know a broker that's actually covering this particular stock or an analyst that is. So in order to get those valuations for the future, what I've done is I've conservatively, I've sort of given a haircut to previous performance and expected that to continue. That's how I've got those valuations. Good little company, interesting space, cheap, good quality.
No doubt if they want more information, they can go to your website.
No, if they want more information to buy this, they should go and talk to an advisor.
Fair call. Anything else you want to know about Roger, though, go to his website or maybe join his Facebook page.
Yeah. I'm catching up.
He's catching up.
I'm catching up.
Thanks for your time, mate.
Pleasure, mate.